So the video is about SBI Contra Fund. So this fund is in existence from 5th July 1995, almost 30 years. The present fund manager is Dinesh Balchandran. So he has been managing this fund from May 2018. So the investment strategy would be contrarian. That is like what contrarian means is what it is not something which the market is believing, and these ideas are something which are which is in contra to the views of the mainstream, right? So that way you try to again, when somebody is investing with this strategy, you have to understand that time period for this idea for the see, when somebody is investing with a contrarian strategy, what it means is you're not doing what the entire market is doing. So it takes for the market to realize about this opportunity. Only once the market realizes about this opportunity, that's when you get the results. So whenever somebody is investing in such kind of funds, you have to wait for a longer durations than even the normal ones. So the exit load is 1% before 1 year. So again, for any equity fund, the ideal time duration is more than 5 years. So if somebody with less than 1 year shouldn't even look for it. So these exit loads, it doesn't even matter for an investor who is horizon is over 5 years. So the benchmark they have taken is Nifty 500. So they are expected to invest in contrarian ideas across the top 500 companies. The present AUM is approximately around 40,000 crores. So the direct expense ratio is 0.76%. The regular expense ratio is 1.54%. So that means the distributor may get approximately around 0.78%. Of course, there are some marketing expenses which the fund passes on to the investor. So as a result, 0.78 percent may not be the exact amount a distributor receives. It will be slightly lower. Uh, so if a so if a financial advisor is recommending this after GST, if his fees is over 0.78%, then obviously it becomes more expensive compared to a distributor. So this, whether paying this extra amount makes only sense when the distributor or the financial advisor is helping you with their financial plan or else goal planning. And if they are helping you with the asset allocation and they are reaching out to you regularly, and at the same time understanding your financial condition, and accordingly if they're helping you with the investments, then by all the means you have to pay them. Otherwise, if you are a do it yourself investor, so it makes more sense if you're going for the direct for the direct funds. So that way you'll be saving that extra. And at the same time, when you are going for a direct funds, you have to look at the performance tracker as well. So let's just look at the analysis, how it has stacked against various indices. So on a 10-year period, this fund has outperformed the different indices. So again, Nifty 500 is where approximately the returns are around 14.64% on a 10-year basis, the minimum, and the median is at 18.39%. And you are comparing this with the Nifty 500, this is around 14%. So obviously for Nifty 50, Nifty Sensex and Nifty 100, which are the large cap funds, this fund has done better than that. So, but again, in the last 10 years, the small caps and the mid caps have done better than the large caps. That was the cycle which was there. And of course, if the fund manager has put in more money on that side, then obviously he will be having a better returns there. Let's look at the charts and analyze how the fund has done across the time period. So the data is available from 13th. Even this data is from January 1, 2013. That's what is available in the Google Finance. So from January 1, 2013, if you look at the chart, the fund has done pretty much as the index, right? So till 2000, yeah, till 2015, 16, till 16, there was not much of a difference. So Nifty 500 is at 130, and the fund was performing at 138, 140. Right? There is hardly any difference in the first 3 years. And even if you are looking till the 2017, the first 5 years, not much of an outperformance for somebody who has invested in the beginning. So the outperformance is just over 5%. So from 2018 to today, again, if we can see some divergence here in 2018 itself. But overall, by the time if somebody has invested in 2008, 18. So till 2022 July, so the returns are almost pretty much in line with the index. So for the 5 years, the fund has not moved. So the fund started more. There is a divergence between the performance of the fund and index only from late 2022 till present, right? So there's a huge divergence. So if you are looking from 2013 to present day, somebody who has invested in 2013 and stayed put till 2021, mid of 2021, it has pretty much done as much as the index. Even Nifty 500, Nifty 50, Sensex, both the direct and the regular funds have done something similar. Only the divergence you are seeing, this has changed only in 2021, and as a result of which you are seeing the results, right? But there are multiple times the fund managers would have changed. And can we attribute this change performance to the present fund manager is the question. So this fund manager has started in 2018. So till 2022 mid, his performance has been as much as the index. Again, only from 2022 have the things changed. So when you are investing in such kind of funds, you have to understand uh, if you are assuming that this has been institutionalized. So for the first 10 years, there has hardly been any return which was greater than the index. So from January 1st, 2013 till 22 of April, there was hardly any movement if you look at it, right? So 21 of April, sorry. So there was hardly any movement, 21 of May. So almost 10 years, there is hardly any movement. So this fund started performing from 2021 onwards. So when somebody is investing, you have to look at the underlying, what all stocks are there. Are they just hugging the index is something which you have to look at. So if the weightages are different, see, when you are looking for a contrarian strategy, ideally you expect things which will not be similar to the index. You want the constituents to be something different, and at the same time, you want the weightages of the constituents have to be different as well. So if the performance is something like a pretty much similar, then most likely the constituents would also have been something similar. The weightage would also be something similar, right? So probably the fund manager change has worked for them. So, but historically looking at it, things have not been so great for this fund. Again, you have to do your own due diligence before investing in such funds. You have to understand what is the strategy. You will be having scheme information documents where you can find all the key strategies. And at the same time, if you look at the monthly fact sheets or the portfolio disclosures, you will understand how the things have been changing and how the fund manager is taking the calls. If it is institutionalized, how the AMC is taking the calls is something you have to understand. So, and at the same time, your distributor or an advisor have to discuss with you and help you in this aspect and explain to you the funds as well. So until such time, not just this fund, any other fund, you should not never go for it until and unless you will have a total information, right? And until and unless you totally understand about that fund. So this video is for educational purpose only. The fund in discussion is neither a recommendation to buy nor a recommendation to sell. Please do the due diligence, and you have to understand that. So whenever you are going for a fund, you have to see if it is fitting to your asset allocation and is it fitting to your financial or else the financial goals. Thank you.